Numbers Man here from the Jerry Pippin broadcast booth as we normally operate out of. Been a very interesting week. We'll look at some anecdotal information here. We don't have the data sets, but from what the shutdown caused, some preliminary reasons, we using an article from the BBC on why the shutdown ended, and we'll put in some of our little commentary here. As we normally do, we partner with Cranston Analytics. We were looking at the shutdown and when would be the optimum point in terms of weeks that it would take to settle this particular situation, the standoff with the administration. One of the things to remember from the political side, once a shutdown, as a shutout too, occurs after the first week, it becomes very tenuous if an agreement is not reached. And every additional week, it's much more tenuous. And our model basically saw 1.5 weeks as the optimum point. In other words, we would have went into February, and then at that point in time, the Trump administration would have thrown up the white flags. We would have had a permanent solution. Now, the solution that is out there now is just a few weeks to decide what to do in terms of the shutdown. It was caused by funding for the so-called protection wall. Well, none of that appeared. And the problem is when you use a shutdown, which is a lockout of federal workers, a form of economic violence, and you don't obtain your objective, then you are in a loss-loss situation, not in a win-win situation, in a loss-loss situation. So the political headlines are out there. Trump is now seen as a wimp. Well, the problem there is when you're in the commercial media and that happens, and then you go back and look at the administration, particularly in the economic field, what has been the accomplishments? Well, there was a tax cut. But because of the nature of tax cuts, people forget about it after April 15th. In other words, that was in 2017. They got their returns back in 2018, and they forgot about it because it becomes a part, quote-unquote, of their routine, a financial routine. So thus, there's nothing happening on that particular field. So now we look to other types of legislation. There was the Affordable Care Act, Obamacare. This administration tried to abolish it and failed to do that. Now that the Democrats have the House of Representatives, they're not going to be able to do that, at least not in the little less than 2 years that this administration has. Now, a re-election situation, we won't venture to that in this format. Well, what we'll do today here, we'll look at the shutdown from this anecdotal information. We'll also look at the IMF. We'll have the IMF presentation, about 30 minutes, will be after us. And we also have some figures from the British government, Office of Statistics. So this will be basically our data sets today. If we have any more commentary, we'll get to those. But let's rush to the shutdown. This is from the BBC's business page. The travel industry was stressed. Well, no doubt about that. The the pain was starting to come to the Transportation and Security Administration. Number of absences there from the TCS workers that examine baggage. And also, meanwhile, airline executives had warned that a fall in government business. Now, this is one of the things, as well as a wider concern about travel, were affecting bookings. Southwest, for example, estimated the shutdown cost 10 to 15 million dollars. That is 7.6 million pounds. In January revenue, it also said it was forced to postpone news service to Hawaii. And in Washington, no doubt people were reeling there. The Washington area was an estimated 1 in 6 workers was affected. That's a lot of workers. And that shaved 2.5% off of quarterly economic growth in that region. And that's now through March, but it will be a big, and that is from Regional Economic Model Inc. Frederick Trazer is the chief economist there. That is an area that expanded at 2.1. That was in 2017. Despite the pain, the administration was widely criticized for being unsympathetic. That's not an economic thing. That is more on the political side. Old Wilbur Ross at the Commerce Department suggested that Commerce workers at the Commerce Department take out loans at I saw a figure 9%. But the widened fear of policy errors were growing as the impasse halted the release, and this is one of the reasons we have here close to watch statistics, the GDP figures at retail sales, housing starts. The fact that reliable measurements of recent GDP and its components are unavailable and can only generate more economic uncertainty. And that is one of the situations in a business environment. You have to have some degree of certainty. Now, you can't have absolute certainty. There's always risks involved, but you do need to have some certainty that the institutions are there. You can't operate like a banana republic. The University of Michigan, we did that last week. That is a survey of consumer sentiment, fell to its lowest point since DJ Trump has been in the office. So this is some of the things that happened. And this shutdown was a little bit different in that it only took into account certain federal agencies, but the ones that it did cover, like the Commerce Department, that'd be the Bureau of Statistics there that we use, and the Transportation Security Agency that passengers use. But the important part of this is business passengers and government business. Now, one of the things that people don't realize is how much business these airliners actually do with, quote-unquote, the government. And that is where you have the situation between a state and a private industry, much more there, and the number also of government contractors that have been laid off, which is in the thousands. There's no really accurate measurement of how many are out there, but they are out there. So the Chamber of Commerce, let's see, this is someone based, Greg Fitzgerald's president of a Virginia-based contract information coalition. At a Chamber of Commerce meeting, he said the firm is yet to be paid for government work it completed in December. So you go back beyond that and had to place 200 of its of the firm's 350 staff on leave. Major layoff going there. And this is the whole month of December. They have not been paid. In other words, not processed. Now, when these workers go back to work, Next week they'll be still processing to see exactly where that will end up in terms of time, etc. The IRS, another very big component in this scenario. Many of the workers there in the thousands did not show up because although they were asked to come in or ordered in or whatever you want to call it, they were not being paid, so they just took an extra holiday. Period. So you're looking in these nations, and while we're here with the UK, Goldman Sachs and the Basics investment warning big problems for the Conservative government in the UK, no doubt about it. They have issued a warning. This is the organization Goldman Sachs. The chief economist the chief executive, actually, Goldman Sachs, says that it's difficult. Brexit will negatively impact its investment plans in the UK, period. The Wall Street giant employs 6,000 people in the UK. Many of these people will be leaving the UK and they are moving elsewhere, period. Now, some of the of Goldman's UK staff, a few have in the dozens have been asked to be moved to other European locations. The bank has added hundreds of staff to offices in Frankfurt, in Paris, in Stockholm, in Milan, and Madrid in Spain. Basics is a concern for the bank. It is not on the top list of worries, as according to this particular report here. While some see the U.S. as the aggressor in a trade war with China, Simon has simply with the Trump administration to reset the rules. But that is the long game, period. And as we move on into the IMF, he hopes that the U.S. and China can resolve their differences in March. That's a long ways away. A global recession. Now we hear the word recession. The chatter in the congressional halls, the reception halls, and restaurants is focused on the U.S. and China. The Goldman boss, as they call him here, didn't think a global recession was immense, but he said there is a 15% chance of a downturn. We at Cranston Analytics feel that there's much more than 15% and a 50% chance next year. We would say the chance is more than 50% this year, and next year we'll see. Neither Simon or anyone else in Davos is prepared to make such a precise estimate. Well, you don't get precise estimates anymore in these kinds of matters. You have to look in the tea leaves. In other words, you're not going to get any of the analysts to say, okay, we're going to have, well, you will get some. Let me just walk that back, as they say. You will get some that say that it will be a recession here. Now, this is from the International Monetary Fund. We'll go to the PDF and we'll just hit some of the high points. The reason being excuse me. Global expansion has weakened. This is the IMF report. You'll hear much of this. Has weakened. The global growth from 2018 is estimated to be at 3.7 as of October. That's from the World Economic Outlook. Forecast despite weak performances in some economies, notably in Europe and in Asia. The global economy is projected to grow at 3.5%. That's this year in 2019, and 3.6% in 2020. And let's see, 0.2 and 0.1 percentage below the our last October projections. The global forecast for 1920 has already been revised down, and it will be revised down more than before. Risk to global growth nudges to the downside. escalation of trade tensions. We've been talking about a range of triggers beyond the escalating trade tensions. It could spark a further deterioration, and this is one of the things that talk about all the time. And in macroeconomics, quote-unquote little things that can cause very big problems and unforeseen problems. Softening momentum, high uncertainty, and this is back to this is the International Monetary Fund here, talking about it. New fuel standards in Germany, natural disasters in Japan. These are all now in the model. It used to be at one time tsunamis, hurricanes, earthquakes were not in most economic models. Today they are weighed on activity in large economies, but these developments occur against a backdrop of weakening financial market sentiment, trade policy uncertainty, and concerns about China. China is about 6.5% now is what we are seeing in China. Let me just move along here. Commodities and inflation, crude oil prices, they have been volatile since August, reflecting supply information, including U.S. policy on the Iranian oil. That is most recent fears of softening global demand. That is the more important factor in what happened in Iran, and we'll mention Venezuela now also, that they're in the stage of a coup d'etat there. Will that affect the international petrol market? No, because Venezuela has, by and large, been off target. The other producers, the Russian Federation, Saudi Arabia, will make up for that, and also the fracking market in the U.S. Prices of metals, agricultural commodities have softened slightly since August due to subdued demand from China. No doubt the Chinese puzzle will affect many things here. Financial conditions in advanced countries, we're seeing more of that while the Federal Reserve has raised the target interest rates to 2.25, 2.50, basically 25 basis points. So that is more normalcy now. Most of the analysts expect at least 2 raises this year, perhaps 3. So we'll see, depending on how things are going. Now, there is still how the unemployment situation and also pricing, because we do have, particularly at the level of food and some other things, rents, mortgage rates, those are going up. So some inflation is built into the economy that has to be watched very carefully. Central banks in emerging economies, they're talking about Indonesia here. We don't know much about them. The Philippines, Russia, South Africa, Thailand, and Mexico to raise policy rates since the fall. By contrast, the central bank in China and in India maintaining rates on hold and acting to ease domestic funding conditions by lowering reserve requirements for banks. And as early as January, with some notable exceptions, that is Mexico and Pakistan. Now, we don't hear much about, definitely about Pakistan. Capital flows and exchange rates, with investors generally lowering exposure to risky assets. Emerging market economies experience net capital outflows in Q3 of 18 as early as January. The U.S. dollar remains broadly unchanged in real effects relative to September. The euro has weakened by about 2%. The pound has weakened also, and I don't know, we'll get to that in this particular situation or not. For the U.S., these includes tariff on solar panels, washing machines, aluminum, aluminium, however you want to pronounce it, steel, announced the first half of 2018 a 25% tariff on $50 billion worth of imports from China, and a 10% tariff on an additional $200 billion imports from China, and latter raising to 25 after the 90-day truce that will end, incidentally, in March. For China forecasts incorporate tariffs ranging from 5 to 10% on 60 billion imports from the U.S. The average price of oil of petrol is projected to be below 60% per barrel in 2019 and 2020, down from about 69 to 66. Their mineral price expected to decrease about 7.4% year over year. A deep decline thus anticipated in late October. That's in 2019, to remain roughly unchanged. And when you see commodity prices going down, that also means demand is going down. And the big question mark out there, you're going to start getting back into this deflationary thing that Japan had at one time. Global growth in 2018 is estimated to be at 3.7. 3.7 is very, very healthy for modern industrial economies. Weakness in the second half of 2018 will carry on to quarters. That usually happens, is projected to decline to, this is 3.5 in, well, that's not bad. Generally speaking, in these industrial economies, if you can be anywhere from 2.5 to 3% is a very good growth for the U.S. and some of these other economies out there. Contractions in Argentina, and Turkey. Argentina's got a lot of problems, more so than Turkey. Specifically, growth in advanced economies is projected to slow from an estimated 2.3%, that was in 18, to 2% in 2019 this year, and 1.7% in 2020. Estimated growth rates for 18 and the projection for 2019 are 0.1 percentage point lower than in October. So they revised these down, but it is a guess. Growth in the euro area is set to moderate from 1.8% to 1.6% in 19, at a 0.3 lower than projected last fall. So the euro is going to be weak. We get to the UK here, is about 1.5% growth in the UK in 19 and 20, unchanged projection related to October. Growth in emerging and developing Asia will dip from 6.5% in 2018 to 6.3% in 19, 6.4% in 2020, despite fiscal stimulus in China. Growth in emerging and developing Europe in 19 is expected to weaken more than the previously anticipated 0.7 from 3.8 in 2018. Buying growth in Central and Eastern Europe before the recovery to 2.4 in 2020. So you're starting to see a pattern here of less growth across the world. The Latin American sector, they call it Latin America, from 1.1 in 2018 to 2 in 19, and 2.5 actually, a little better growth there. Revisions are due to downgrade in Mexico's growth perspective in 2019-2020. And we finally get to Venezuela, more than previously anticipated. Severe contractions there. Down is particularly offset by upward revisions in 2019 forecast for Brazil, where the gradual recovery from the recession. They've been in a recession in Brazil. 2015, 2016 is expected to continue. Argentina's economy will contrast in 2019 as a tighter policy aimed at reducing imbalances, slow domestic demand before returning in 2020 maybe. Growth in the Mideast and North Africa, Afghanistan, Pakistan region expected to remain subdued at 2.4%, not bad at all. And it'll get back to about 3%. So they'll actually be in a little bit better shape there than some of the so-called industrial countries. The signing on the 30th of November, that is the U.S., Mexico, Canadian trade agreement to replace NAFTA, the December 1 announcement of the China truce. Can't do much about that because we have to see what is going to happen as we move down and finishing up this report. And we have actually finished it up. Let's see here. These are some estimate projections here. Advanced economies at 3.8%, at 3.7% in 2018, 3.5 and 3.6 2020. And we go down here. Well, look at Canada. In 2017, they were at 3%, 2018, 2.1%, and 2019, the projection is 1.9% and 1.9% in 2020. So the Canadians aren't really going anywhere, so to speak. They're the emerging economies, markets, and developing economies, 2.4, 2.7%, 2.6%, let me start this over. 4.7% and 4.6% and 4.5% there. So the emerging economies are doing much better here than some of the others. And if we look down here, I think we already gave these. The Mideast, North Africa, Afghanistan, Pakistan, 217, 2.2, 2.4, 2.4, and 3% in 2020. And who else do we have here? We already talked about commodity prices. The London Interbank offered a rate, a percentage there. The dollar deposit 6 was 1.5, 2.5, and 3.2. The Eurozone deposit, the 3-month deposit, is in a negative 0.3 tenths, negative 0.3 tenths, negative 0.3 tenths. So that is the report there from the World Outlook update. So this is what we have, and the International Monetary Fund, which incidentally is based in Washington. And we can flip back here. Let's see if we're going to... I believe this is... Yeah. Oh, nope. Sorry about that. Wrong. Absolutely wrong situation. It was a Pew study. We're not doing that one. Okay. Now let's see. We can find the the UK labor market in January. This is from the Office of National Statistics. Let me just make sure that we've got the latest part here. Okay. January of 2019, the estimate of employment and unemployment, economic inactivity, and other related subjects. We'll append this on with their main points from September to November of 2018. The estimate for the labor force survey shows that between June and August, in September to November, the number of people in work increased, the number of unemployed people with little change, and the number of people aged 16 to 64 not working and not seeking work, inactive, decreased. There were an estimated 32.53 million people in work, and 141,000 more from June to August. That's in 2018. And 328,000 more than a year ago. This is in the UK. the unemployment range, the portion of people from age, they're saying age 16 to 64 who were working, estimated to be at a high of 75.8, then a year earlier at 75.3, the highest compared estimate began in 1971. There were an estimated 1.3 million unemployed people, people not in work there, and in from June to August of the last year, 2018, 68,000 fewer than a year earlier. The unemployment rate, the number of people unemployed, was in the UK at 4%. Has not been so low since December of 1974 to February of 75. Very interesting there. I don't have, how many people were in the economy. We can assume it was much smaller at that time. The summary here, is season adjusted. Basically, we'll just append this is what we went over. 65 and older, they're 10,615, and that change would be 26. And what else do we have here? This is just about the release itself, and see if we got. This is released on the 22nd of January, and the next release will be on the 19th of February 2019. And we don't have a PDF here. I'm assuming because we probably don't need one. Oh, we do. Just to make sure we didn't miss anything, I can get it a little bit larger here using the PDF, and I think this the labor force survey shows that between June and July of 2018, September to November, the number of people working increased. The number of unemployed people, little change there. I don't think we missed anything. The summary of the statistics. Basically about the same thing. Age 16 to 64. In thousands, yeah. 8,648 over 65, 10,641. Number of person employed, divided by the population age. This is 16 to 64, their retirement age there. How it was calculated, full-time employed in the thousands. Let's see, this is just in November. Yeah, okay, anyway. Let's see, we get to highlights here. Nice graphs here. You enjoy looking at them. From September of 2018, there was an estimated 5.36 million people employed. This is in the public sector. Now, we didn't get to that before. Little changed, down 2,000 compared with June of 2018. Very, very small there. Was largely due to transfer of Scottish Housing Associations to the public sector. Now, this is something we would have not seen, and this is very good. Between 2017 2018, September of that, public sector employment was estimated to have fallen by 120,000. So largely, fall was entirely due to the transfer of housing associations in England. It would be in December of 2018 in Wales, in June of 2018 in Scotland, in September to the private sector. Excluding housing associations, the transfer, the number of people employed in the public sector was estimated to increase by 51,000, mainly due to more people working for the National Health Service. From September of 2018, there were 1.66 million people employed in the National Health Service, as 31.1 of all people employed in the public sector, very large sectors in the U.S. There were 1.51 million people employed in the public education sector, 28.1 of all public sector employees. So, as shown over that, employment in the National Health Service has steadily increased, while employment in public education remains about the same. Actual hours worked, let's see, pay per hour, this is in the UK, incidentally increased 1.2% to 1.4 temps B in hours. This is from September to November of 17 and September to November of 2018. Number of people employed in the UK increased by 1% to reach 32.53 million. So this is the workforce, a little bit of commentary here. We've already talked about that. Repeat ourselves too many times. And then we go to various sectors of employment here. The average pay, 494 pounds per week in normal terms. That's up from 478 pounds per week. Get a little idea of what's going on here in the UK. Won't get into it much more than that. Regular pay in normal terms increased by 3.3%. Annual rate has not been higher since September to November 2008. That's coming out of the Depression. Now, this is in for November of 2018 in Great Britain. Now this is before your deductions and were taken out, what was that, 5 something there. Working days are lost in the 12 days. The unemployment figure, we talked about it running about 4. The unemployment rate for men was at 4.1%, lower than the estimate earlier of 4.3%. This is in September to November 2018. The unemployment rate for all people was at 4%. It's not been that low since 1974. And let's see. For people who have been unemployed for 6 months or in 1 year, little change. So they had 219,000 people who have been unemployed for over a year. The hardcore there at 347,000, and that's 37,000 less. Now the rate for men. Wait a minute, this minute here. The rate for all people at 21% lower than the 20.2%. The rate for men at 16.1%. I'm not sure what we're getting here. Rate for women at 25.7%. From September to November, there was an estimated 8.65 million people aged 16 to 64 not in work, neither seeking or available for work. A little different, they do it there, but in the U.S., but basically about the same. Things, with young people in the workforce, number of people employed, a little change there. I believe they're talking about UK household population is falling for those age. This is 16 to 24. There were 3.87 million there. The estimated number of unemployed people fell by 27,000 to roughly a half million. Won't spend a lot of time on that. You can look at that later. But basically, not a bad report for the UK. If you start summing it up by groups year over year. So we'll just append this. We won't mess around with it. We'll append it. Anyway, we've taken care of that, got it out of the way, and let me look at our time here. We're running a little bit over. So let's do the market data, and then we'll have the press conference by the managing director, Madame Lagarde of the INF. We'll have that in. Nonetheless, the FTSE was in the negative at 0.14 in the negative there. That's the FTSE 100 in the UK. In Amsterdam, they were at 0.98 in the positive. In France, they were at 1.11 in the positive. In Frankfurt, they were at 1.36 in the positive. The Euro Strasse at 1.18. In Madrid, they were at 0.38. Skipping to Bombay, they were at negative 0.47. The Hang Seng was at 1.65. These were on Friday, I believe. And the Nikkei at 0.97. The Dow in New York was at 0.75 on Friday. The Nasdaq at 1.29. And out in Chicago, they were at 0.85. And the commodities, Brent crude actually was up at Brent crude futures at $61.64. It was up 90 cents. Anyway, West Texas crude was up $1.05 at $53.68. Holding that, T-Boone picking it in his retirement, still jumping for joy. On the Forex, gold was up 0.25 at $1,282.95. Bing. And we don't have silver here, so we don't have to. Silver will just, as they say, have to be wanting. And we'll have to look at it later in the scheme of things. Let me just very quickly look at Reuters here and make sure I had not missed anything I looked at earlier. We covered the, let's see. Okay, no. Nothing here. Consumer confidence in focus as shutdown fears fade. Now, this is kind of interesting here. This is from Reuters. The U.S. economy lost at least $6 billion to the government shutdown. Here, it has lost that much money. This is S&P Global Ratings said during the shutdown due to lost productivity from workers and economic loss activity. That is what they estimate at. And, of course, we don't have any solid figures on that, although the shutdowns ended. A little agreement on Capitol Hill likely weighed on business confidence. It was a 35-day shutdown there, so we got it from them. It's going to be more than $6 million. I can tell you that real quickly here. $6 billion. Much more than that. And it's going to take a little while for us to get any accurate numbers on this. Let's see. MoneyGram evidently is thinking about selling itself once again. That business is the PayPals, the Apples of the world are all competing with it. Anyway, consumer confidence in the focus. We jump with that. The fund manager continuing their retreat from this is Reuters, from consumer-related stocks, increasing their defense bets on concerns that U.S. economy is slowing, although government leaders have reached an agreement. Well, yeah. The S&P 500 index up more than 4% since January. Money managers, including Federated Investors and Hodges Capital, are bracing for powerful kickoff effects on consumers. The shutdown left roughly 800,000 government workers out of work so we have that going on. Market right now is retreating like it's a hurricane. When you know there's an economic impact, you tend to discount any hit to the data. Well, no doubt about that. That is portfolio manager Federated Investors. And several others chimed in here from Sean Krovitz. He's at Expandy Capital LLC. Said he expects the consumer stocks like Walmart, Dollar Store, the Dollar Tree to benefit as furlough workers trade down as more value-oriented chains leaving in the higher-end department stores. No wish to get back on their feet, which is going to take a while to do. That's something I haven't seen. Each of the more than 20 shutdowns since 1970 lasted a week on the average. We talked about that in our introductory when we were coming in here. Well, this one did not. The longest one was a 20-day shutdown. This is 1995. I remember that was under Bill Clinton, 1996. The S&P rose 1/10% during the shutdown, and it gained 4% the month after it finished. Well, that was during the start of the dot-com boom. When we give these, we need to talk a little about the history. Marshall, who is Marshall? Eric Marshall, portfolio manager, Dallas-based Hughes Capital, expects to see more companies lowering guidance. That is more than the so-called shutdown. And now expects to grow S&P at 5.9 in 2019, compared in October's estimate was at 10%. Almost cut it in 10.2, almost cut it in half. So things are happening here that have not happened before. This will no doubt do it for us, for those in business, make next week a productive one. For the consumer, the eyes on the prize. For federal workers, they can leave the food bank in a week or two, and the free lunches and all those kinds of things. They weren't that free. Free coffee. They turned the whole Washington, Virginia, Maryland, and over to West Virginia into a soup line economy. Unfortunate situation. Nonetheless, for us at Cranston Analytics, this is M.A. We'll talk to you next week. On to Chairman Lagarde and the press conference, the International Monetary Fund. Incidentally, we'll have coverage of the World Economic Forum. That will come out today, starting the first day, and the various other sessions we've been looking at. And on our international channel, that's BR on the World, we'll be talking about Venezuela and some of the effects of the Red Vest program. They are still around. The Yellow Vest program, they're still around. They're in their 11th week, so we cover international affairs here also as a part of the Bostonred Network.
Good afternoon, everyone, and welcome to this press conference on behalf of the International Monetary Fund. I'm Jerry Rice of the Communication Department, and the occasion today is the release of our update to the World Economic Outlook. I'm very pleased that we have with us today the Managing Director of the IMF, Madame Christine Lagarde. We also have with us our Economic Counselor and Director of the Research Department, Geeta Gopinath. And just to Geeta's left, we have the Deputy Director of that department, who is Gian Maria Milesi Ferretti. So I'm going to ask the Managing Director to make a few opening remarks, followed by Gita, and then we'll come to your questions. Thank you, Managing Director.
Thank you very much, Jerry, and thank you and good afternoon to all of you. It's very nice to see many familiar faces and good friends and to be back in Davos this year. It also gives me huge pleasure, actually, to introduce to you, if you hadn't met her before or didn't know her or of her, our new Chief Economist, Gita Gopina. We're delighted that she has joined us, and we're all extremely pleased to work together, and I'm really honored that we are sharing the podium today for you. I'm also very grateful to Klaus Schwab and to the World Economic Forum who are giving us a chance to present the update to our World Economic Outlook this year. And it will be my privilege to say a few remarks without giving you much by way of numbers, because that is the remit of Gita and Gian Maria. So, how many of you do cross-country skiing here? No? Oh, thank you. Brilliant. Because I want to run the analogy of cross-country skiing for you. I'm not good at downhill, but cross-country I'm okay. So what do you like when you're a cross-country skier? You like good visibility. No uncertainty. What else do you like? You like when it's kind of stable, and eventually when it's a little bit downhill. You know, risks down, no hazards along the way. Yeah. Third thing you really like as well when you're a cross-country skier is everybody skiing in the tracks. Okay? Now move that to the global economy for a second. Last October, assume we had started cross-country skiing in October, we downgraded our growth forecast a little bit. Risks were on the rise. We had bad news on the trade front, if not actually materializing, at least for some it was, but certainly threats. Well, I'm afraid that we are going to announce a further downward revision of our forecast. So the cross-country skiing is going to be more laborious. More efforts will be required. And the bottom line is that after 2 years of solid expansion, the world economy is growing more slowly than expected, and risks are rising. But even as the economy continues to move ahead, as I said, it is facing significantly higher risks, some of them actually related to policy. And these risks are increasingly intertwined. Think of how higher tariffs and rising uncertainty over future trade policy fed into lower asset prices and higher market volatility. This in turn contributed to tightening financing conditions, including for advanced economies, which is a major risk factor in a world of high debt burden. Now, does that mean that a global recession is around the corner? No. But the risk of a sharper decline in global growth has certainly increased. Add to this the uncertainty, the geopolitical worries, and disappointing long-term growth prospect, and you have an economic picture with a pretty clear message. And the message is the following for policymakers. Address remaining vulnerabilities and be ready if a serious slowdown were to materialize. Now, what does that mean? For most countries, it means harnessing the existing growth momentum, because yes, there is growth, in order to create more policy room to act. And the goal is to make sure that economies are more resilient, they are more inclusive, and they move towards more collaboration. So let me distinguish each of these three. more resilient. In terms of policies, it means reducing high government debt, because that would open space that is needed to fight future downward. But this must be done in a fair and growth-friendly fashion. Monetary policy should be data-dependent, and exchange rates should be allowed to act as shock absorbers. Developing macroprudential tools will further financial sector stability and reduce potential vulnerabilities. This also remains the time for economic reforms in order to lift growth, especially in labor markets and infrastructure investments. That's what I mean by resilient. Inclusive. If we are to deliver on the promise of the digital revolution that will be much talked about, in terms of productivity, in terms of employment, and in terms of long-term growth, then we must make sure that it delivers for all people. And that includes helping workers that are displaced as a result of transformations and automation. It means creating new and better opportunities for women, and in particular for young people. This is the theme that I will address in various forums in the next few days. Resilient, inclusive. My third point is collaboration. Effective international cooperation comes down to fairness, to flexibility, and to a commitment for the common good. And that's where solidarity also means self-interest. I will develop that theme in the next few days as well. So what we need to do, all policymakers, all skiers following the tracks, we need to redouble our effort to resolve the shared problems that we are facing. From fixing the global trade system, yes, the G20 has called for that, and it needs to be delivered upon, to fighting corruption and tax evasion, to addressing the existential threat of climate change. What's in it for the IMF? Well, the IMF needs to be in a strong position in order to help all countries. Because history suggests that somewhere over the horizon, there will be unexpected developments. The international community must come together to build a brighter future for all. I've called this a new multilateralism. And again, we will be developing that topic in the next few months as it applies to macroeconomic policies in all its dimensions and structural reforms as they need to be applied in many corners of the world. Those were my messages. I'm going to disappear and leave the floor to our most eminent economists, starting with our chief economist, Gita. Floor is yours.
Thank you, Managing Director. So I will flesh out a little more what's in the outlook. While global growth in 2018 remained close to post-crisis highs, the global expansion is weakening and at a rate that is somewhat faster than expected. This update of the World Economic Outlook projects global growth at 3.5% in 2019 and 3.6% in 2020. That is 0.2 and 0.1 percentage point below last October's projections. Now, the downward revisions are modest. However, we believe the risks to more significant downward corrections are rising. While financial markets in advanced economies appear to be decoupled from trade tensions for much of 2018, the two have become intertwined more recently, tightening financial conditions and escalating the risks to global growth. We have revised downwards our forecast for advanced economies slightly, mainly due to downward revisions for the euro area. Within the euro area, the significant revisions are for Germany, where production difficulties in the auto sector and lower external demand will weigh on growth in 2019. And for Italy, where sovereign and financial risks and the interconnections between the two are adding to headwinds to growth. The US expansion continues, but the forecast remains for a deceleration with the unwinding of the fiscal stimulus. Across advanced economies, we foresee growth to slow from 2.3% in 2018 to 2% in 2019 and 1.7% in 2020. This softening growth momentum has provided little lift to inflation. While core inflation is close to target in the US, where growth is above trend, it is significantly below target in both the euro area and Japan. Economic activity in emerging and developing countries is also projected to tick down to 4.5% in 2019, with a rebound to 4.9% in 2020. The projection for 2019 has been lowered from October, mainly because of a large projected contraction in Turkey, amid policy tightening and adjustment to more restrictive external financing conditions. There is also a significant downgrade to growth in Mexico in 2019 and 2020, reflecting lower private investment. The projected rebound in 2020 is due to an expected recovery in Argentina and Turkey. The outlook for emerging markets and developing economies reflects the continued headwinds from weaker capital flows following the higher US policy rates and exchange rate depreciations, even though they have become less extreme. Across emerging economies, some of the pickup in inflation reversed towards the end of 2018. Overall, the cyclical forces that propelled broad-based growth since the second half of 2017 may be weakening somewhat faster than we expected in October. Trade and investment have slowed. Industrial production outside the US has decelerated, and purchasing managers' indices have weak flagging softening momentum. While this does not mean we are staring at an imminent major downturn, it is important to take stock of the many rising risks. An escalation of trade tensions and a worsening of financial conditions are two key sources of risk to the outlook. Higher trade uncertainty will further dampen investment and disrupt global supply chains. A more serious tightening of financial conditions is particularly costly given the high levels of public and private sector debt in countries. In other risks, China's growth slowdown could be faster than expected, especially if trade tensions continue, and this can trigger abrupt sell-offs in financial and commodity markets, as was the case in 2015-2016. In Europe, the Brexit cliffhanger continues, and the costly spillover between sovereign and financial risks in Italy remain a threat. In the US, a protracted federal government shutdown poses downside risks. Given this backdrop, policymakers need to act now to reverse headwinds to growth and to prepare for the next downturn. The main policy priority is for countries to resolve cooperatively and quickly their trade disagreements and the resulting policy uncertainty, rather than raising harmful barriers and further destabilizing an already slowing global economy. The call of G20 leaders to reform the World Trade Organization in Buenos Aires must be accomplished. Where fiscal space is low, fiscal policy needs to adjust in a growth-friendly manner to ensure public debt is on a sustainable path while protecting the most vulnerable. Monetary policy in advanced economies should continue to normalize carefully. The major central banks are keenly aware of the slowing momentum, and we expect they will calibrate their next steps in line with these developments. Macroprudential tools should be used where financial vulnerabilities are building up. And across all economies, measures to boost potential output growth and enhance inclusiveness are imperatives. Lastly, given that policy space for countries is more limited than in 2008, multilateral cooperation will be even more important in the event of a sharper decline in global growth. And it is essential that multilateral institutions like the International Monetary Fund have adequate resources to deal with the rising risks. Thank you.
Thank you very much, Gita. Let me turn to some questions in the room. If you could please identify yourself by name and affiliation, then we will try and take as many questions as we can. Let me begin with lady down front. Can you hold on for the microphone?
Very much. I'm Julie from iPhone.com of China. My question to Gita. What's your expectation on Brexit deal and its impact on the global economy? And what's your suggestion to the leaders of EU and Britain how to break the deadlock of Brexit deal if the second voting is failed? Thank you very much.
A no-deal Brexit is one of the major risks to our forecast. Our forecast incorporate a smooth transition, that a deal is actually made, and that there is a smooth transition to the new setup. But if there is a disruptive exit, or if there is continued uncertainty for many more months, both of those are going to weigh negatively on growth going forward. And I think it is imperative for the leaders to resolve this uncertainty immediately.
Thank you. Bloomberg in the second row here, if you can wait for the mic.
Thank you very much. Eric Martin with Bloomberg. I wanted to ask about the modeling for some of the trade scenarios that you mentioned and the downside risks from the trade war. In particular, what would be the consequences for the global economy of an end to the current truce between the U.S. and China on trade?
That would be an upside risk. We had looked into this very closely in the October WEO.
And end to the current truce, that things worsen from where they are now.
Oh, things worsen. Okay, well, then that would certainly be a worsening of the outlook. When we did a major update in last October following the trade tensions, the assumptions were that the higher tariff rate on Chinese imports, U.S. imports from China, the 25% higher rate, would come into play. So if on the plus side that isn't the case, then that would be a positive upside risk. But if on the other hand, if it is a much more serious deterioration in the trade tensions, then that would be a much more significant downside risk.
Okay, I'm going to swing down to the front. Lady in the front. Yes, ma'am.
Sylvia Mata from CNBC. Hello. I have a question about China because we received the new GDP figures earlier this morning confirming the slowest growth rate since 1990. How worried are you about China and whether this will transition into a wider global growth slowdown? Thank you.
The numbers that we saw for China today are actually completely consistent with our forecast. So our estimate for 2018 was 6.6%, which is exactly where it came in. So what that means is that we're certainly not seeing any big rise in a faster pace of slowing down. This is consistent with the level of maturity of the Chinese economy, the rebalancing of China's economy. And so this is, I would think of it as a positive reinforcing of the fact that China's growth, while slowing, which is to be expected, nothing dramatic is happening at this point.
Okay, thank you very much. I'm going to take the other side of the room here. Yes, sir, in the front row. I think it's Arabic News.
Hi, thanks. Arab News, Frank Kane, Arab News of Saudi Arabia. Just on the oil price, your forecast less than $60 for the next 2 years is rather more pessimistic than many others. Can you say how you got to that figure?
Yep, you're right about the numbers, and I'm going to hand over this question to Gian Maria.
So our forecast for the oil price is based on futures prices. And that is what futures prices indicated at the time we finalized our forecast. That is a broadly horizontal path for oil prices from staying below 60, between 55 and 60. So that is what underpins our forecast.
El País in the third row. Lady in the third row, please.
Hello, Alicia Gonzalez from El País. I've seen the differences you made in your assessment for two economies with new governments. It is Mexico and Brazil. Why do you see a deterioration in one hand for Mexico, and then you have a more upset assessment for the Brazilian economy? Is it for the reforms or the policies announced? Thank you.
For Brazil, we are seeing continued growth, and these are coming a lot from cyclical factors, which is a recovery from the downturn, and so that's a cyclical expansion that we are incorporating in there. There are still risks to Brazil's outlook too, in the sense that very high levels of debt for Brazil remains an issue. In the case of Mexico, the downward revisions are because of policy uncertainty and the dampening effect we expect that has on private sector investment. And I'm going to let Gian Maria jump in here if he would like to add anything.
Yes, I would just add that for Mexico, we see a somewhat weaker momentum coming in 2019. So that is one factor also contributing to our down revision. But I think it's important when one compares the two to understand that Brazil comes out of a very deep recession in 2015-16 with very moderate growth since then, and needs more room to close the output gap. Mexico come from a period of not spectacular but more stable growth.
Thank you. I'm going to take ITV way at the back.
Hello there, Joel Hills from ITV News. Gita, in Britain we are obsessed with the British Brexit cliffhanger, as you put it. I wonder what your view is. What is the biggest risk to the British economy? Is it slowdown in China, or is it disorderly Brexit, in your view?
The immediate risk would have to be Brexit. The uncertainty associated with what the outcome is going to be come March, I think, has to be the dominant factor.
And how much longer can this uncertainty continue before it damages the economy?
We've already seen the negative effect of this uncertainty on British investment. We have done our estimates of what it would be, how costly it would be to the British economy to have a no-deal Brexit, which would be a reversal to WTO rules. And that would be a decline in long-run output of long-run GDP of between 5 to 8 percentage points. So those would be quite significant. It is absolutely essential that this uncertainty is resolved sooner than later.
Goodness, can I just ask a supplementary,
thank you very much,
Jerry, on that?
I'm going to turn. Lady next to you, please.
Hi, Isha Nelson from Quartz. I think one of the things that's noticeable about this year's World Economic Forum is the political leaders that are missing because they're dealing with national crises at home. You briefly mentioned the shutdown. Obviously, we just talked about Brexit, but I wanted to introduce France as well and the Yellow Vest protests happening there. And just ask, how much longer do these particular instances have to go on before you start to see measurable impact on the national economies and then also the global economy? Thank you.
Political risks are clearly very important. And in France, we actually reduced our estimates, so we revised our forecast downwards slightly, but because of the Yellow Vest protests that we had towards the end of last year. I think what is important, instead of waiting for an escalation of these political risks, is for leaders to immediately take actions that prevent such unhappiness with the way things are working out for some sections of society, and these are real, genuine concerns that need to be addressed.
Okay, thank you very much. New York Times, please.
Keith Bradshaw, New York Times. A question on LDCs. Are you concerned to see rising foreign debt among many of the poorest countries at a time when there are also concerns about falling commodity prices as the world's economy slows, and also we see less and less of that debt covered by Paris Club? Thank you.
What our report highlights is that there is actually a great deal of heterogeneity in how LDCs are doing. So it is not one story for all LDCs. And that is heartening, given that actually there has been a fair amount of financial turmoil in 2018. Now, it is indeed the case that for some countries, the fact that they still have high debt levels, and we are, financial risks are one of the major factors that we are flagging in this report. It is an important concern and is an important downside factor. For commodity prices, 2018, the initial part of 2018 was good for commodity exporters, and actually that increased our estimates for 2018 for some of those countries. But going forward, with commodity prices coming down, that is a negative impact for those economies.
Thank you very much. I'm going to take two more questions. One at the very back. Gentleman. Yes, sir. You can hold on for the mic.
I'm Ihab Alogli from Al Jazeera News Channel. You just said about you expected that the price of the oil would be between 55 and 60. What do you expect that impact on the GCC countries' economies and the growth in it, especially Saudi Arabia, which is considered one of the most exporters of from the Middle East? And what's the impact on the other countries that are in relations with the GCC countries in the Middle East, like North Africa and all those countries?
The decline in oil prices and the projections for oil going forward certainly weaken growth for major commodity exporters, including Saudi Arabia. I'm going to let Gian Maria add to that.
Yeah, so the downward revision for Saudi Arabia's growth forecast for 2019 is 0.6%, comes from the decision to restrict oil production taken at the OPEC plus meeting in December. So it's reduced, a bit reduced oil output growth, and that is the reason for the revision. There are other offsetting factors, but not strong enough. So fiscal policy has become more expansionary in Saudi Arabia, so the non-oil part of the economy is picking up a bit more, but in the aggregate, there is a negative impact because of the reduced production of oil. You mentioned spillovers to other countries. Of course, typically, if you have a slowdown in GCC countries, you will see somewhat lower remittances that affect some of the countries that send a lot of workers to the region. At the same time, some of these countries may be oil importers, so while they get lower remittances, think of Pakistan or Bangladesh, they would also benefit on the other side from reduced outlays for oil purchases. So the net impact in some cases for importers is going to be positive, but again, this remittances channel is an important one to take into account.
Thank you, Gian Maria. Okay, I'm going to make this the last question, so I'm going to take the gentleman here. Thank you, sir.
Thank you. Cameron with China Central TV Business Channel. So I want to know what's your take on China's tax cuts, especially the latest round, which is the personal income tax cuts, which aims to free financial burden for middle and low income groups. Will those rounds of tax cuts serve to cushion some downside risk and increase domestic consumption in the year of 2019?
The tax cuts for that China implemented, along with the loosening of reserve requirements, both of those are factors that cushioned, in our opinion, the negative impact of trade uncertainty, the trade tariffs, and which is why we haven't changed actually our forecast for China going forward since October. So we think of both of those as having played a useful role. We, however, continue to flag that it's important for China to ring-fence its financial sector, to make sure that credit growth is sustainable, that there is financial regulatory reform, and there's still a rebalancing of the economy away from industry towards services. So that has to continue to be the medium-term, long-term goal for China.
Thank you very much, Gita. Thank you, Gian Maria. And thanks to all of you. We'll see you in the course of the coming week. Thanks.